Hello, everyone, and welcome to this WTR Symposium Series, Catch the Wave, Investing in Water Treatment and Solutions. I'm your host, Shawn Severson, founding partner and CEO of WTR Research. I'd like to introduce my WTR Research Analyst co-host for the conference today, Jeff Robertson, Managing Director, Natural Resources, and Peter Gastreich, Senior Energy and Sustainability Analyst. Jeff and Peter, welcome to the conference.
Thanks, Shawn.
Thanks, Shawn. It's great to be here.
So, in our special extended podcast today, we will interview management of four companies whose growth strategies are built around water treatment solutions, infrastructure, or other water-related investment opportunities. Before we get started, Peter, could you share a little background on our symposium podcast format?
Yes, absolutely, Shawn. So our aim with this symposium format is to package an investment theme that is relevant to multiple companies, and in today's case, across multiple sectors. And we invite senior management of the companies to discuss the relevance of that theme. As always at Water Tower Research, we design content that is easily digestible for investors. We'll keep the Q&A with management punchy, and we're going to focus our discussions mostly on how water treatment and solutions fits into the growth strategies of the companies. Following a few days later, Jeff Robertson and I will publish a key takeaway report, so please have a look at that. In that report, we will include links to other relevant WTR Research content that will help investors who may want to dig a bit deeper into the broader strategies and outlooks for the companies that we're speaking with today. To remind, our content at Water Tower Research is entirely open access and can be found on our website at www.watertowerresearch.com. For those with access, investors can also find our content on research aggregators like FactSet and Bloomberg. Finally, we'd love to hear what you think about this symposium. So please feel free to leave comments, or to reach out directly to our host, Shawn Severson, Jeff Robertson, or myself on LinkedIn or by email.
Great. Thanks, Peter. With the housekeeping notes out of the way, let's dig into the companies. Can you and Jeff let us know who we'll be speaking with today?
Yeah, Shawn, absolutely. So for our speakers, we're excited to include senior management from four listed companies. The first two I'll be speaking with, which are ARC Incorporated, ticker ARQ, California Water Services Group, ticker CWT. And the second two companies Jeff will be speaking with, National Energy Services Reunited, ticker NESR, and Select Water Solutions, ticker WTTR. Joining us from ARC is Chief Executive Officer Robert Rasmus. ARC is an environmental tech company producing activated carbon products that reduce or reverse environmental liabilities. ARC is executing a growth strategy with technology aimed at removing forever chemicals, or PFAS, from public drinking water systems. From California Water Services Group, Jim Lynch, Senior Vice President, Chief Financial Officer, and Treasurer, is joining us. CWT provides high-quality, affordable water and wastewater services west of the Mississippi. The Water Infrastructure Improvement Plan in California could be a significant driver of growth if that is approved. I'll pass over to Jeff here for the management that he'll be speaking with.
Thank you, Peter. We've got two companies that primarily are focused on the oil and natural gas production business. From NESR, we have Blake Gendron, who's Vice President of Investor Relations and their NEDA segment. NESR is the largest publicly traded pure-play diversified oilfield services company that is focused solely on serving national oil companies and international oil company customers in most of the major markets in the Middle East and North Africa. The company has a unique strategy around produced water and is working on converting that to beneficial use, and also in some mineral extraction technologies. For Select Water Solutions, we have Michael Skarke. Michael is the Executive Vice President, Chief Operating Officer. Select provides full cycle water treatment and integrated solutions such as recycling, gathering, disposal for customers in the oil and natural gas industry in the U.S., where it operates in nearly every producing basin. In February, the company announced a joint venture to enter the industrial, agricultural, and municipal markets in southern Colorado that provides a long runway infrastructure addition to its business. With that, Shawn, I'll turn it back over to you.
Great. Thanks, Jeff. Very exciting lineup. Looking forward to it. So let's jump into it and get started. For our first guest, we are pleased to welcome Robert Rasmus, Chief Executive Officer of ARC Inc. Bob, thank you for attending our symposium today. I'll kick it off with the first question before passing it over to Peter. I'd like to start with kind of an overview for the benefit of any investors who are not yet familiar with ARC. Could you please give a short background of yourself and a high-level overview of ARC's operations and business?
Sure, Shawn, and thanks for including me in the company today. My background is fairly simple. I've got a long history of starting or expanding businesses in a variety of fields, the finance market, the energy market, the oil and gas market, the energy services markets. And I was really intrigued by the opportunity and what I looked at as kind of the value that was undiscovered at ARC. So that's what brought me to ARC, because I saw it was a combination of both turning around the business as well as expanding into a new market, both of which are right up my skill set from my past history. At ARC, what our products, which are principally almost exclusively activated carbon, are used to reduce or even reverse harmful environmental liabilities such as PFAS or forever chemicals, scrubbing mercury emissions from coal-fired power plants, improving the taste and odor of drinking water, things such as that.
Okay. So thanks, Bob. That was a great introduction. Could you please share how water treatment fits into your growth strategy? And within this, it'd be great if you could give some perspective on what the addressable market for that application may look like.
Sure. I mean, water treatment is clearly a growth focus, as primarily as it relates to granular activated carbon, but it also is a component in terms of improving and preventing pollution remediation as part of our PAC business as well. But it's the ability of our granular activated carbon to be able to remediate PFAS, capture PFAS from municipal drinking water, is one of the clear growth drivers for ARC. When we look at the market currently for municipal water for granular activated carbon, we see roughly 170, 180 million pounds per year. We think to meet the EPA requirements, that's going to have to expand by 3 to 5 times. So if you look at it, 500 to 850 million plus on top of the existing 170 million pounds. So it's a very attractive market for us, and it's going to be one of the key growth turbocharged engines for us going forward.
Okay, thanks, Bob. And then how would you intend to address that market in terms of the strategy for your capacity expansion?
So really 2 ways. One, as I mentioned, that water is a key driver, but there's also the renewable natural gas market for us as well. I want to spread our industry risk across multiple industries as it relates to that, but that we are in the process of finishing commissioning on the first 25 million pound expansion into the granular activated carbon market, that expansion being at our Red River, Louisiana plant. We would then fairly quickly make the financial investment decision to go into a second phase of expansion, which would be another 25 million pounds, and we could eventually expand up to being 125 million pounds of granular activated carbon production through our Red River, Louisiana facility. And we believe we're already fully permitted on phase 2 as well.
Okay, thank you. Could you please discuss what the proprietary aspects of your solutions are, and how would you characterize your competition or any competing technologies out there to activated carbon products?
Sure. So on the granular activated carbon side, that we have a patent protected process to turn bituminous coal waste into granular activated carbon. So we take waste, we use that as the feedstock and use that feedstock to create granular activated carbon. And so we essentially get 2 bites at the environmental or green apple by taking waste and using that to remediate other waste. The other interesting factor or key factor for us is because the high quality input for us, that our granular activated carbon, our testing and independent testing shows that our efficacy is 8 to 9 times existing standards of existing product. So we have a unique performance advantage relative to our competition.
Okay, thanks, Bob. There's a question that I'd like to ask all of our guests on our podcasts, and that is, based on your recent conversations that you've had with investors and analysts, what is it that you think people misunderstand most about your company strategy or industry outlook?
I think it's really a couple things. One, that the value of the foundational pack business, that the that Red River, Louisiana plant where we produce powdered activated carbon now really offers us a low cost entry point into the granular activated carbon business. And what I mean by that is it allows us to get in for roughly $3 a pound of capex production capability versus $7 to $8 a pound from a greenfield capacity. The other is we already have a fully integrated supply chain. We also have, I believe, the best in class technical capabilities. And granular activated carbon is a technical sale, so that we already have a great imprimatur when we go out to customers or potential customers in terms of this, getting into the granular activated carbon business. And we believe that foundational pack business is going to give us a 3 to 5 year head start versus greenfield or even versus some of the existing competition. And you combine that with the fully integrated, fully domestic supply chain that helps us with the Buy America, Build America, Built in America. And also, we're immune to tariffs because virtually everything we do is done on a domestic basis. So I think those are the two major components. And a third would be that, you asked about water. People focused on water because the EPA, regulations and pronouncements tend to focus on water, but water is by far from the only driver of granular activated carbon growth going forward. There's renewable natural gas, there's food and beverage and other segments.
Okay, great. Thank you. It's very clear. So, looking ahead into 2025 and beyond, for your company, what do you think investors should be focused on, and what are the major signposts that are ahead?
I think, we're certainly aware of that investors are focused on, and we are definitely focused on completing commissioning of that first line of granular activated carbon. I'm confident in the guidance we gave on our last call of completing that by the end of the second quarter or very early in the third quarter of this year. So that's one. That's clearly an important signpost for us and investors. I think the second would be what's the ramp up to getting up to full run rate production once we announce that we have completed commissioning and we are in full commercial production, because I think that's really the key to realizing the earnings potential and the growth potential of the granular activated carbon product. And that, I think those are the key things. And then going forward in 2025, on the timing of making our financial investment decision on when to expand or begin the process of expanding into line 2 for granular.
Okay, thanks, Bob. This has been great. Really, there's a lot coming ahead with your company. You've got a big demand opportunity ahead. You're capturing the opportunity there with the low cost of brownfield expansion that's really going to drive your business going forwards. First mover advantage here as well, and a lot of catalysts there that investors can be looking out for. But so thank you so much. I am afraid we have hit our time, so we'll need to wrap it up there. But this has been super helpful for investors who are tuning in. Bob, thank you so much for your time, and we hope you can join us for a future event.
Thank you very much, Shawn and Peter. I appreciate it and look forward to it.
For our next guest, we're very pleased to welcome Jim Lynch, Senior Vice President, Chief Financial Officer, and Treasurer of California Water Services Group. Jim, thank you for attending our symposium today.
I appreciate it, Shawn. Thanks for having me.
And I'll kick it off with the first question, and then I'll pass it over to Peter for the rest. But for the first question, and to the benefit of any investors who might not be familiar with CWT, could you please give us a short background on yourself and a high-level overview of CWT's operations?
Perfect. Well, I am, as you mentioned, the Chief Financial Officer of California Water Service Group. I've been in my current role for about a year and a half. Prior to joining Cal Water, I served as the Chief Financial Officer for another California water utility, one that's actually just down the street, and I was there for 13 years. And then prior to that, I was an audit partner with KPMG. Before getting started, I do need to provide our forward-looking statement disclosures, so kind of please bear with me on that. During the podcast, I may make certain forward-looking statements because the statements deal with future events. They are subject to various risks and uncertainties, and actual results could differ materially from the company's current expectations. As a result, I encourage you to carefully read the company's disclosures on risks and uncertainties in our Forms 10-K, 10-Q, and press releases and other reports filed with the SEC. So with that out of the way, I'd like to give a brief introduction of Cal Water. California Water Service Group is a publicly traded holding company. We have operations in California, Hawaii, New Mexico, and Washington, and we are engaged in the delivery of water and wastewater services. In addition, we have a utility in Texas that has a 94% investment in a joint venture that owns 7 greenfield water and wastewater utilities in the Austin and San Antonio corridor. Through our operating utilities, we provide affordable water and wastewater services to around 2.1 million customers through 560,000 service connections, and over 500,000 of those connections are actually located in California. Our California utility represents over 90% of our operations and generates about 92% of our total revenue. In 2024, we reported net income of $191 million on revenue of approximately $1 billion. Keep in mind that our 2024 results include interim rate relief from our delayed 2021 California general rate case, and we do consider that interim rate relief to be non-recurring. Roughly speaking, the interim rate relief added about $64 million in net income and about $87 million in revenue to our 2024 performance. We have an A+ stable credit rating from S&P, and our first mortgage bonds are rated AA-, and we trade under the ticker symbol CWT on the New York Stock Exchange.
Okay, thanks, Jim. That was great introduction. Could you please, dig a bit more into what your growth strategy looks like, and within this, can you give some perspective on the scale of, future market opportunity for you?
Yeah, I certainly would. Our future revenue growth is going to be driven primarily by rate base expansion. We're regulated in each of the states we operate in, and we're allowed to earn a return on our authorized equity portion of our capital structure that's used to fund the capital investments. That's the main driver of rate-based growth, those capital investments. The majority of our systems were put in place in the 40s and the 50s, and we're nearing the end of their useful lives. So our planned capital investment between 2025 through 2027 is estimated to be over $2 billion. Those investments are estimated to grow our rate base from about $2.4 billion at the end of 2024 to over $3.3 billion at the end of 2027. The majority of our rate base is in California, and in California, we currently earn a return on our equity of 10.27%. So we've got a lot of potential growth there when considering our return on equity. I should point out that our planned capital investments are subject to approval in terms of amounts requested in our 2024 California general rate case, which we're currently undertaking. California is a forward-looking test state, and then we also have prudency reviews in our other states. Those are historic-looking test states. From strategic acquisitions, that's really the second prong of our growth strategy. Much of our attention is focused in this part of our strategy in Texas. As I mentioned, the Texas joint venture owns 7 wastewater and water utilities in the corridor between San Antonio and Austin. Our utilities are greenfield, so currently we have about 4,000 customer connections and about 10,000 potential connections tied to developer commitments. In addition, we believe the existing service area has a capacity for an additional 20,000 connections, and looking beyond our service area outside, contiguous to those locations, we see that there's a potential for an extra 100,000 connections. We're currently in the midst of prosecuting our first rate case in Texas that, if successful, would lead to uniform rates across our service territories. So we're really excited about the opportunities that Texas is presenting to our company. We also have regular opportunities to expand the existing territories that we have in our other states through contiguous system acquisitions. And we're constantly looking for new platforms in our existing and new states where there's opportunistic growth opportunities. I think due to the existing rate base growth and the Texas growth, we can be selective with our other M&A and judicious, and that's kind of our approach right now. Having said that, over the past 5 years, through our normal strategic acquisition activity, we've added more than 47,000 new customer connections.
Okay, thanks, Jim. It sounds like CWT has a nice blend of both organic opportunities as well as acquisition. Could we sort of turn over to PFAS, or so-called forever chemicals? We have these new regulations that have come out from the EPA, I guess, last year. I'd just be sort of curious, what that means for your company. What sort of solutions are you considering, and what are the implications for your costs and margins, as well as prices you may need to charge to your customers?
Yeah, it's a great question. Even more recently than a year ago, the EPA has come out and has actually made some changes to certain of the MCLs that were previously announced. The forever chemicals that they referred to as Gen X and the hazard index mix of those chemicals, plus a fourth chemical, were rescinded. But they kept PFAS and PFOA in place, and the current MCL also in place at 4 parts per trillion. At the same time, the EPA did extend the compliance deadline 2 years from 2029 to 2031. We've tested all of our groundwater sources for PFAS and PFOA and have identified 110 wells that require treatment. Due to the age of some of the wells, we may replace them rather than treat the source. The total cost for the treatment or replacing the wells, we've estimated at about $226 million. The majority of the treatment infrastructure is scheduled for our service territories between 2026 and 2027. So there's a lot of near-term opportunity for us for investment for at least the treatment portion of the PFAS predicament. In addition, we are going to replace some of the wells rather than put treatment there. Now, a well replacement typically takes about 5 to 7 years from start to finish. It includes purchasing property and locating the wells and finding good water source locations above the aquifers. So those investments will be made over a longer period of time. The cost of the treatment infrastructure is not included in our plan 2025 and 2026 capital expenditures. And in California, where the majority of our contaminated wells are located, we will apply for recovery of that infrastructure using an advice letter process, which is a process that is outside of the general rate case process. We're also involved in certain litigation seeking recovery from the identified responsible parties. So any recoveries that we are able to get will be used to offset the cost of the PFAS and PFOA investments. And then with regard to the ongoing operating cost, we'll incorporate that into our normal rate case sequencing and seek recovery through the state regulatory processes.
Okay, thanks. Can I just ask, in terms of that treatment, are you using activated carbon for that?
That's the most common and the most effective treatment right now. And fortunately, it's also treatment that we have on certain wells that we use for other contaminants. So it's already in place. So for the time being, we'll continue down that path. There are other alternatives that don't require quite as big a footprint on the area where the well is located. And to the extent that we're not able to get the carbon activated treatment in the footprint, we'll take a look at those alternative technologies.
Okay, great. Thank you. My next question, this is something I'd like to ask our guests, sort of give you an opportunity here. Based on your recent conversations, what do you think investors and analysts misunderstand most about your company or strategy or industry outlook?
It's a great question, Peter. So, first of all, I think cutting to the very simplistic investment strategy, we have a very simple earnings model. We invest or reinvest in water and wastewater infrastructure, and we're allowed to earn a return on the investment. The costs that we incur beyond that, water supply costs and operating costs, those are generally flow through. And though they're subject to regulatory approval, they're generally things that we can pass along without having to have the shareholders pick up those costs. To provide service, we need to continually reinvest in the existing water system. The cost of the investment today, it's significantly greater than it was when it was originally installed. Some of the installations we have go back as far as 60 or 70 years. And so, when we put the original infrastructure in place, or that infrastructure, the costs are much lower. So there's clearly a steady earnings growth opportunity for infrastructure investment. And, that's probably better for us than opportunistic M&A activity, which, though we're also pursuing, doesn't have quite the certainty around it as the regulatory model. So I think that's one thing that M&A activity is certainly something that we pursue, but we put an awful lot of effort in terms in just the system renewal and replacement, because that's kind of the bread and butter, and that's what allows us to deliver safe and reliable services. I think a second thing is there's a perception in California, which is where our significant operations are, that it's a difficult regulatory environment. And it's true that it's a challenge sometimes to navigate some of the commission's priorities and some of their decisions. California actually has a very constructive regulatory environment. They've got some very constructive features. We're a forward-looking test year state, and that reduces regulatory lag on invested capital and cost recovery. We have a 3-year regulatory cycle that is required, so it allows for more contemporaneous recovery of operating costs. And we have balancing and memorandum account tracking devices, basically, which allow us to capture uncertain cost at the time of rate cases and provide an opportunity for recovery interim rate cases, depending upon meeting certain of the requirements for seeking that recovery. So yeah, California is difficult, but it's really from a structural standpoint a very strong state from a regulatory construct.
Okay, got it. So looking ahead in 2025 and beyond, when you think about signposts that are ahead, what would you suggest that investors should be focused on, say over the next 25, early 26?
Yeah, it's a great question, Peter. I think right now, if I could approach it both from a macro level and then for Cal Water, at the macro level, the reality is interest rates remain high right now, and the capital markets, with the tariff news and the active news cycle that we're dealing with, have been very volatile. I think as the impact of those events start to dissipate, and assuming interest rates start to trend down as inflation trends down, there's not a huge impact in terms of cost associated with the tariffs. I think the market for water utility stocks should strengthen. I think we continue to provide a predictable return. We continue to provide a good growth thesis just in our normal meat and potatoes sort of operations, and we continue to develop or continue to deliver a valuable product to our customers. And so I think there's a lot of opportunity in basically the water utility space as the macro environmental or economic environment starts to kind of get a little more stable, if you will. I think for Cal Water, the timing of the general rate case decision in California, our 2021 general rate case, that was 15 minutes late, or 15 months late, I should say. And while we did have interim rate relief, which is another real strong tool in the California regulatory tool chest, we it created variations in the timing of both our earnings and our cash flows that, quite frankly, were difficult to navigate and difficult to explain. We're currently following the proposed schedule for our next rate case, our 2024 general rate case. General rate cases in California are about an 18-month sort of a beginning to end process. The hearings are now complete, and we are starting to prepare briefs by both us and the other members to the or other parties to the proceeding. So we're tracking very well in terms of the 2024 GRC. It should be noted that in the 2021 general rate case, when we finally did get the decision, the commissioners acknowledged that they needed to be better regarding timeliness. And so based on that and the fact that decisions that were issued after our 2021 rate case was done were more on time, if not on time, in terms of their own issuances. So we're expecting a similar outcome for our 2024 rate case decision. And we're working towards hopefully a successful and timely completion of that.
Okay, well, Jim, I'm afraid we are running out of time here, so we will need to conclude. But thank you so much for joining us today. We really appreciate your time and your participation, and we do hope you can join us for a future event so we can dig, deeper into the outlook for CWT. Thank you so much.
I look forward to it. Thank you, Peter.
The guest for our next segment is National Energy Services Reunited, or NESR for short. We're pleased to be joined by Blake Gendron, NESR's Vice President, Investor Relations, and NEDA segment. I will start before turning it over to you, Jeff. I just have a quick question to begin with. Blake, for those who may not be familiar with NESR, can you share a brief description of the range of oilfield service product lines that the company provides to its customer base in the Middle East and North African markets?
Sure. Yeah. First of all, thanks, Shawn and Jeff, for having me on. It's a good opportunity to address something that we like to talk a lot about, but don't have the opportunities quite as frequently. So NESR is the largest publicly listed Middle East, North Africa diversified services company. So we provide the full range of oilfield services, much like an SLB or a Halliburton. But think of us as pure play Middle East, North Africa, and that was the impetus for founding the company, was to offer investors a pure play into this very stable and very durable growth market.
Blake, let me ask you, since you talked about the market in the Middle East and North Africa being stable, what's it like, or how does NESR compete with the big global service companies like SLB and Halliburton, and work with companies like Saudi Aramco and Kuwait Oil Company and in Oman, which are some of the largest national oil companies in the world?
Yeah, absolutely. So we're a company of 7,000 plus employees across 15 countries. 80% of our business is in the GCC. We have production services that comprise 70% of our business, and drilling and evaluation that comprises the other 30%. So our largest segments are much like those of the large multinational firms. So think of well testing, coil tubing, cementing, hydraulic fracturing, certainly in Saudi Arabia. Now, traditionally, this is a $20 billion upstream services market that's been dominated by the multinational firms going back, decades from the birth of upstream in this part of the world. And there's been a slow shift in the market structure over time. So whereas historically it's been 80% Big Four, now the national oil companies are putting more emphasis and more market share to the companies that they view as more local or regional. So the whole point of founding NESR in 2017 was to create a multinational within the Middle East, North Africa market, one that's known as the national champion. So I would say there are 2 points of differentiation with NESR. Number one, just the sheer operational execution, especially in our largest segments. And number two is our open technology platform. The way I would describe the open technology platform is investors don't necessarily have to take any risk in R&D when they invest in NESR. We have the anchor country footprint. We're in the biggest countries. We're working with the largest NOCs. We're truly known as a local provider of diversified oil field services. And so we go out and we find unique technologies within the oil field and outside the oil field in the case of the water business, which we'll get into later. And by importing these technologies, we de-risk their, I would say, migration into the region, because it's a very hard region to get into from a barriers to entry standpoint. And for us, we have our, pick of the best technologies that are out there, and we're able to streamline the importation of those technologies very quickly.
Our symposium is really focused on water, and we're going to address some of the specifics about water in the Middle East. But before we talk about the NETA segment in particular, Blake, are there any requirements or special requirements that are unique to the countries in the Middle East that NESR does business in, especially within your production services segment where you provide hydraulic stimulation to your customers?
Yeah, look, I would say that produced water is a challenge in the Middle East, much like it is in the US and elsewhere. There are standards and regulations by which the national oil companies and the multinational IOCs need to handle and dispose of their produced water. But the challenge on the produced water handling side isn't nearly what you see in, say, the Permian, both from an environmental standpoint and then also from a right of way and land use perspective. Because at the end of the day, the national oil companies are the governments and vice versa. So they have the benefit, I would say, in terms of scale and in terms of the way that they handle the vast amounts of produced water that are coming out of the upstream reservoirs. Just to give people an idea, the industry globally produces 5 or 6 barrels of produced water per barrel of oil. So, the Middle East, if you consider North Africa too as a part, produces upwards of 70 to 80 million barrels per day of water, far more than it produces oil. So it is a bottleneck like it is anywhere else. But I would say that the countries have perhaps less stringent ways of handling and disposal. Where they do have a challenge, of course, is in the freshwater side of the coin. So obviously, it's the region with the lowest renewable freshwater resources globally. Freshwater comes at a very high price. I would say 80 to 90% of the global seawater desalination capacity is in the Middle East. And so the value that can be unlocked as it relates to reuse of produced water really comes from the relative lack of freshwater resources in the region.
We've seen a shift in the Permian Basin, which is obviously an arid region, as unconventional resource development has taken off over the last decade and a half and put more strain on their freshwater and caused operators and companies to push more for recycling solutions. As you alluded to, is the unconventional resource development that is gaining steam in places like Saudi Arabia and other regions, is that putting more emphasis on solving the produced water problem and providing enough water for drilling and stimulation, but also just solving a beneficial reuse problem?
Yeah, there's already a lack of fresh water in the region, and most of it, like I said, comes from industrial seawater desalination plants. And then when you talk about the unconventionals, it's a very high intensity part of the oil field, both with respect to the services and the service content, and also as it relates to the water consumption. So Saudi Arabia, and I think everybody knows the story with Jafurah, it's a key strategic focus because part of Saudi Vision 2030 is increasing gas production 60% from 2021 levels, and essentially getting to electricity production of about 50% renewables and gas by 2030, and vastly offsetting, the crude burn that they have for electricity. So the activity and the investment is going into Jafurah, but water is one of the key challenges. And with Jafurah virtually tripling in terms of volume over the next few years, and NESR has been a key player in the hydraulic fracturing services, as you alluded to. We are working very closely with our largest customer on how we can identify other sources of water for this unconventional ramp. Aramco themselves have issued a water neutrality directive, essentially incentivizing all aspects of the upstream activity to stop using groundwater and to find alternative sources of water. And that's really where our produced water technology journey started with Aramco 3 or 4 years ago. So unconventionals obviously is a driver. I would say conventional activity is also a driver. And then you're starting to see the proliferation of unconventionals in places like UAE, Oman has unconventionals, Egypt has unconventionals, Algeria. There's a lot of unconventional resource potential. And with the high intensity of the unconventionals comes the challenge of water usage and also water handling and disposal. And so this is a market that's being created in real time. but one that we think is going to rival some of our biggest segments over the coming decades.
Can you talk a little bit about the background of NEDA, and was that really organized into a specific segment to deal with some of these challenges that NESR saw coming on the horizon?
Yeah, absolutely. So we launched the what was known as the ESG impact segment in 2021, and it started with a handful of technology partnerships in the area of water treatment, and also some VC type investments in things like methane detection and heat capture to power. So the ambition of the segment was to kind of duplicate what we have in the core oilfield services business, just be an open technology platform, but one focused on sustainability where we kind of thread the needle between obviously hydrocarbons being an important part of the energy mix for the foreseeable future, but that we need to produce these hydrocarbons at a much lower carbon intensity. So essentially to decarbonize the production of oil and gas. But water was the key focus, and I would say what was unique in 2021 about the ESG impact segment was these were water technologies that came from not just outside of the Middle East, North Africa region, but they came outside of the oil and gas sector altogether. So we partnered with a technology, a thermal desalination technology that came out of the Dutch dairy industry at that time. That was kind of the core technology that we've implemented on some of the key pilots in Saudi Arabia. Another technology, was out of the Australian metals and mining industry, and so we adapted that and deployed that in Iraq to essentially harness unusable brackish water for the production of kill fluid. So I would say the unique approach that we take in being an open technology platform is some of the best technologies, they already exist, but they exist outside of the oil and gas industry, and they exist, quite frankly, outside of the Middle East, and we're the platform that can streamline those technologies into the region. We rebranded ESG Impact in 2023 alongside the inauguration of our research facility in Saudi's Dhahran Techno Valley. We now call it the NEDA segment. It stands for NESR Environmental and Decarbonization Applications, but more straightforwardly translates in Arabic to call to action. So it's really our call to action of the industry in decarbonizing the operations, and specifically for our industry to be, better stewards of the water resources that are obviously lacking in our part of the world.
From an economic standpoint, then, and from NESR standpoint, it sounds like the real benefit of the initiatives that the company is undertaking is to create value through beneficial reuse and potentially critical mineral extraction from what has traditionally been more of a wastewater stream. Am I thinking about that correctly?
Absolutely, you're thinking about it correctly, and it's something that's being talked more and more about in the upstream oil and gas industry. It's been talked about, I would say, more earnestly over the past 3 to 5 years, but very few companies have actually generated the results in the field like we have. So just to give you a bit of brief background in our piloting in Saudi Arabia, like I said, we aligned with a Dutch thermal desalination technology, one that came out of the dairy industry. And our first application that we wanted to tackle was a very simple circular water, produced water reuse. So our largest customer has very high salinity produced water in all of its production facilities. I would say at least 80,000 ppm or higher is the salinity. So this is not water that can easily be reused for, say, drilling a well or completing a well or crude desalting, for instance. So our very straightforward application was to desalinate that water, give the fresh water back to the operator, and that operator can use that water for crude desalting and a number of other different uses and offset their water consumption from the aquifer. Now, there is a value to the freshwater, like I said, because there's a lack of renewable freshwater resources, and most of the freshwater in these countries comes from seawater desalination. But I would say water economics alone don't make the entire process click, so to speak, from a financial standpoint. We very quickly, through the duration of these pilots, realized that the real economic value is valorizing some of the minerals and other ions that exist in the water. The challenge, of course, is, how do you extract these minerals to the great impurity that make them usable in other industries or within the oil and gas industry, number one. And number two, every water is different. So all of these processes have to be specifically tailored to the produced water that you're talking about. So I actually have some samples here, if you can see on the screen, of some high quality industrial minerals that we're now exploring the production of out of the produced water in Saudi Arabia. And this is what's going to drive the economics. The Middle East imports industrial minerals to the tune of 60 billion per year. So it's actually multiples of our upstream oil and gas services business. And then when you consider, the diversification of the economy that Saudi is endeavoring, investing up to 600 billion in petrochemical and other end markets, these are all markets that will need minerals and salts and things that actually exist in the oil field water. So it's not that we're creating multiple circular economies just within the oil and gas industry. What we're trying to do is create circular economies across multiple industries. And I would say we're just in inning one, Jeff, of this journey.
Well, in any pilot, you're trying to get, I think, to a point where you can prove that a technology, one, works, and then secondly, can be deployed at scale. Can you share any thoughts on how long it takes to get from the first inning to, say, the fifth or sixth inning?
Sure. We're still in inning one, and we've been doing this for 3 or 4 years, going back to the original, water desalination, the pure water application. So we have 2 critical pilots that are upcoming. Actually more than 2, but 2 that are starting imminently. One is in our largest country, in which we're actually trying to recover high quality divalent salts. So think of calcium carbonate, think of strontium sulfate, think of magnesium. What's crucial in this pilot is a lot of these divalent ions are kind of viewed as a scaling constituent or a waste. So the idea is to soften the water and just get rid of these and dispose of these ions. We think they can be harnessed as high purity and high grade industrial salts that can be feedstocks into other industrial processes. So that's one critical pilot. And then another critical pilot is the direct lithium extraction. So this is something that's become a very intense focus in Saudi Arabia. Aramco announced their advanced transition minerals venture, the ATM venture with Ma'aden, which is one of the largest metals and mining companies in the Middle East. With the expressed desire to recover rare earth minerals, transition minerals, things like lithium from the produced water. So we're going to be one of the players that pilot some of these unique DLE technologies and enables the success at the pilot scale, and hopefully, scale up these more promising technologies. And then, of course, we can explore the recovery of other things, bromine, boron. There are a number of different strategic minerals that exist in oil field water that, from a geopolitical standpoint, are of great interest to some of these countries. And then, of course, you pilot these things and you get success at the field level. Then the question becomes how you scale. I would say that that's going to be for innings 2 through 5. We're not quite there yet. But we're excited to be on the leading edge of some of these endeavors, especially with some of our largest customers.
Like, are you seeing interest in some of these technologies or with some of the other national oil companies that you work with? Are they watching pretty closely what you all are trying to do with Aramco?
They are, and everybody's contributing to the scholarship in this area. So I would say our 4 largest countries from an oil field service standpoint are Saudi Arabia, Oman, UAE, and Kuwait. That's about 80% of our business. All of those NOCs and the related multinational IOCs are investigating the produced water potential. I would say that Saudi's established clear leadership. Number one, because they established leadership in a lot of different technology areas in our business. But number 2, they've committed the actual budgets for these pilots. So there's a lot of risk sharing and collaboration on the part of our largest customer with respect to these emerging technologies. If we can prove the economic model in our largest country, I think this is going to be very transferable. Limited, of course, by the uniqueness of the produced water. So even within a country or within a field, produced water varies even from well to well. So these processes have to be heavily tailored, and that's part of the inefficiency of this exercise. However, once you actually establish a full-scale business within a field or a subset of wells, that's a very sticky and very durable market position that can create a lot of value. And this is not a market that exists today. So there aren't tenders out for these types of processes. We're very much in the exploration phase of mineral valorization in oil field water. And so I think that the freshwater challenge is one that pervades the entire industry, but the interest in high value mineral extraction and especially transition mineral production is one that all of our customers are looking at. So this is going to be a very transferable business to the rest of our footprint.
Blake, I think we'll leave it there for today. I want to thank you very much for taking the time to give us a glimpse into NESR's activity or water-related activity in a region that some people may not be as familiar with as they are with the Permian Basin. It'll be quite interesting to see how this evolves in the coming years for NESR and the potential economic impact it can have on the region and on the company. So thank you so much for participating.
Yeah, thanks, Jeff, for the opportunity. This is a business that we think could become one of the biggest within NESR. Now, we're a relatively small company, but as far as opportunities go for oil field services companies, a lot of people talk about AI and digital. We think that minerals is another one that's perhaps underserved and underappreciated by the market.
Thank you.
Thanks.
The guest for our next segment is Select Water Solutions. We are pleased to be joined by Michael Skarke, Select's Executive Vice President and Chief Operating Officer. Before we turn it over to Jeff, I'm going to start out with the first question. Michael, for those who may not be familiar with Select, can you share a brief description of the range of water solutions the company provides to the upstream oil and gas operators, and who are your primary customers?
So at Select, we provide an array of water solutions. That's really all we do, or provide water solutions to our customers. We do it through three different segments. The first is water infrastructure, and water infrastructure consists of pipelines, recycling, and disposal facilities. We support water infrastructure with water services, and those are services that largely support water going in and coming off of our infrastructure, with water transfer being the largest one, which you can think of kind of as a temporary or mobile midstream. And then the last segment is our chemical segment. Oftentimes we find that water is the problem and chemistry is the solution. And so we're leveraging chemistry for our customers directly, but also in our water recycling efforts.
Several years ago, Select made the strategic decision to really concentrate on building up the infrastructure business, which in a way ties the other two segments together. But it also is a business that is your fastest growing and highest margin business. I'd like to spend a little bit of time today just concentrating on the asset base that you are building and have built in the Northern Delaware Basin, where for anybody who's unfamiliar with what Select really is doing is the ability to treat and handle produced water for drilling and completion and production operations is really critical to resource development. In other words, resource development couldn't happen without some of the services that Select provides. Michael, can you just talk about the infrastructure network that Select has put together in the basin and help people understand why your customers require the types of full life cycle solutions that Select provides?
Sure. No, we're very excited about the Northern Delaware and the position that we've built up in, specifically in Lea County, New Mexico. We've put a lot of capital to work over the last couple of years, and I suspect we will continue to do so as we build that out. And really what we like about it is it's a very unique area of the basin and really of the country that has all of the water challenges in one specific area. So maybe spend a little bit of time to elaborate on what I mean by that. We start with just completion water demands. Wells for completion water demand about 500,000 barrels per well. Most of the operators are doing multi-well pads. They're drilling 4 to 8 wells on well pad. So that comes out to 3 to 3.5 million gallons for a single pad. Barrels for a single pad. 3 to 3.5 million barrels for a single pad, which is almost 150,000 gallons. So the completion water demand on a single location is very sizable. And then you look at the production side. So as a well produces its oil, you're producing water alongside of it. And the water to oil ratio in New Mexico are among the highest we have of the major economic play, unconventional plays today. And so looking at kind of that same, call it 6, 7 well pad, in the first month alone, you're going to get 400,000 or 500,000 barrels of produced water back from production on that well. And if you look at it and extrapolate it over the first year, you're going to be in the 5 million barrel range. So there's a tremendous amount of water required to complete these wells. There's a tremendous amount of water that's coming back on the production side over the first year of that life that has to be managed. And coincidentally, what we try to do is we try to link that 5 million barrels of water that's coming back in the first year of life from that single pad with the next completion opportunity that's going to require, call it 4 million barrels. And if you take it maybe one step further, Jeff, just to look at it, New Mexico, operators in New Mexico do not want to use fresh water. The state does not want them using fresh water for completion water. So they're really pushing you towards produced water, which is a great thing for us. And then on the disposal side, the state really doesn't want any more disposal wells. They've been very stingy with permitting new wells. And if you look at the overall production from the basin, you're well north of 5 million barrels a month, 5 million barrels a day. And disposal capacity in the basin is going to be about 3. And so you're producing well in excess of what you have disposal capacity, which means one, either it's going to Texas, which there's issues with seismicity and taking produced water from one state to another, or it's being recycled. And so it's just a really unique area in that you have highly productive rock that produces a lot of water. It doesn't have enough disposal or enough fresh water to support it. And that's really where Select comes into play.
Michael, if I'm a customer on your system, what kind of contract am I working with Select on? And how does the system really help me manage my development program? You talked a little bit about completion and production, but my capital program, if I'm a producer, may be a little bit cyclical where I'm drilling it at one point and maybe not drilling it another time. How does being connected to Select help me manage all of those aspects of my business?
Yeah, I'd start by saying that the contract really depends on your need. So we're able to be very flexible in how we approach the market. I mean, if you're tying in and just an interruptible customer and we service you when we have excess availability or when you have a shortfall, that's one thing. If we're building out to support your long-term program, that's a different type of contract. And so the terms of them really can be tailored based on what you're looking to get out of it. But what I would say is what Select is really excelled at is balancing the longs and shorts of the produced water. It's making sure that we can find the 7-well pad that's going to produce 5 million barrels over the next 12 months, cleaning it up, storing it, and getting it ready for your next, call it 8-well pad that needs 4 million barrels. And in doing that, we're preserving fresh water, we're eliminating the need for disposal, and we're charging you a rate that is going to be materially less than the traditional method. So we might be 30 to 50% cheaper than disposing of that in disposal well and sourcing fresher brackish water. So it's doing the right thing from an ESG sustainability standpoint, saving you money and helping you with the headache of getting rid of and sourcing a large volume of water in a very short time period.
So if you have multiple customers connected into the system, you can, because you're managing the longs and shorts of everybody's program, basically somebody else can be drilling while I'm not, and I can be drilling while they're not, and you all will handle all of the water moving from point A to point B.
We handle it all. We have the infrastructure and we have the services to come off of it. So we're taking care of all the water needs. But you hit on the right point, Jeff, which is the interconnectivity of the system. If you have a single user platform, it's inherently underutilized because you don't have enough produced water to support your completion activity. And then when the completion activity spike, first month of production is your highest month of production, you're building for that peak flow back, and then it trails off. It's just really difficult to manage it. So what we want to do is we want to be connected to everyone. We want to have some customers that they're our highest priority. We do everything they need. We take all of their water, first. We give them all the water first. And we have some intermediate customers that understand they're intermediate. They're not making the same level of commitment to us, and we're going to do everything we can to help them. But they're second. And then we have our interruptible agreements. And the interruptibles are going to be the spot agreements. That's going to be spot market. We're going to be opportunistic, and they're going to be opportunistic. But the point is, when you have a system that spans, 2,500 square miles across Lee and Eddy County, you have a lot of different connections to operators and a lot of different development plans. So there's always someone who is long water and short water And we're able to move water from east to west, north to south simultaneously so that we can collect someone's produced water, treat it for reuse, and then send it back out for completions.
Frequently, when oil and gas operators announce acquisitions, especially in the Permian Basin, one of the things they talk about is water disposal. Can you just talk us specifically about the economic value proposition that Select is delivering to its customers? And then secondly to that, Michael, since you're hooking up to wells who are going to have a very long productive life, does that basically create a barrier to entry to someone else coming in and trying to recreate some of what Select has done?
Yeah, I might start on the second question, then move to the first one, Jeff. On the midstream side, once you have the pipe in the ground, it is uneconomic for someone to come lay it next to us. And so what we're trying to do is build out a very strong position across Lee and Eddy County with supporting a couple of key customers so that we will be able to infill everyone else that operates in that area in between our customer agreements and make sure that we can control all of that water and move it to anyone who needs water from people who need to get rid of it. It would be obviously much more expensive for someone to lay 10 or 20 miles of new pipe just to reach an area where we already have it covered up. The rates they would have to charge would be well in excess of the rates that we're able to charge. So it does put us in a position to really service those customers well, and we'd be competitively advantaged because we'd be laying 1 mile lay versus someone else who's laying 10 or 20 miles. In terms of kind of the value proposition, we're a recycling first organization, so we do have some disposal capacity, but we're really leaning in on the recycling piece. And for the exact reason I mentioned, it's economically a superior model for our customers. It's cheaper for them to send us a barrel for synthetic disposal to be recycled and sent back out to any operator for completions, doesn't matter whom, than it is for them to send that barrel disposal and source a new barrel of fresh or brackish water. And so we believe that recycling first and having as many connections as possible to keep those barrels in circulation supporting oil and gas for as long as you can is the right way to go about it. And that's how we're building the business. And that's why we're putting as much pipe in the ground as we are to make sure that we can access everyone who is active in Lee and Eddy County.
Let's shift gears a bit. In February, Select announced a joint venture agreement to supply water to the municipal, agricultural, and industrial markets in southeastern Colorado. Michael, can you talk a little bit about how this joint venture came to pass and help people understand what the opportunity is that you're pursuing there?
Yeah, and this really is a big transition. It's unlike what we were talking about in New Mexico with produced water infrastructure and recycling and managing kind of long source of water. This is just straight up municipal and industrial water. So we've been in the water market in Colorado for probably 15 years now, and we've been partnered with a number of people who've owned water rights or owned storage, but really haven't participated in it for oil and gas development. It wasn't the right fit for us. This is a group, we ended up partnering with a group. We put $62 million in initially. We put another $10 million in, and we've got another $74 million committed. So we own about 35% of the entity today and expect to have 55% once our investment's fully deployed. This is a group that we know well, and really what they're doing is they're acquiring water rights, and they're supporting local communities, farms, businesses, local industries with fresh water. It's a non-depleting asset that is supported by very long-term contracts. So the return and the return profile is different than what we have kind of on the upstream oil and gas side. But again, it's a non-depleting asset with 20, 30, 50-year contracts. And so we're very excited about it. It's going to take a couple of years for us to really commercialize, But once it's commercialized, it's going to be a high margin business and a nice part of our water strategy.
So to your point on contract length, Michael, if I'm thinking a contract with an oil and gas operator might be, I don't know, 15 years less or less.
That's correct.
These will be multiple lengths of that type of contract if you're supplying municipalities and other types of customers, right?
That's exactly right. So the contracts we have in New Mexico are kind of 7 to 15 years. These are going to be kind of, and we're still working through it, so we have to find out exactly how long they settle, but 20 to 50 years. And they're going to be high margin. We're the resource owner, so it's a different perspective, but it's a perspective that we're very familiar with. And again, we like the non-depleting asset portion. We like servicing, because in this part of Colorado, it is very arid. There's a need for water, so taking these water rights, storing them, and providing it is a real benefit to the communities there.
I guess you benefit from the population growth on the Front Range south between Denver and Colorado Springs, and
You certainly
probably
do.
and then out to the east rather.
And everything associated with the population. I mean, along with the people, you need more businesses, you need more water, and so it all comes together to create a really interesting dynamic, and one that we thought was attractive.
This is still a new venture for Select. Can you tell us over the next, say, 6 to 12 months, what kind of milestones we might expect to see?
When you're negotiating contracts of that tenor, it takes a while to get them across the finish line. And when we look at building out storage commensurate with these types of investments, that also takes a while. So I would say that there's not a lot of milestones in the kind of the 6-month or 9-month. We're really looking and saying, okay, we embarked on this earlier this year. We're thinking we're going to have it largely commercialized in 2 to 3 years, but there's not kind of ratable milestones that we can report on a quarterly or even semi-annually basis. But we are confident that we will meet our 2 to 3 year timeline in terms of commercializing.
I'd like to shift back to the oil and gas business. There's obviously been a lot of macro concern about the direction of oil prices and volatility over the last couple of months. Meanwhile, natural gas prices have been quite strong on the expectation that the U.S. is building out LNG export capacity, especially on the Gulf Coast. Can you just touch on Select's exposure to natural gas directed drilling, especially in an area like the Haynesville Shale region in East Texas and North Louisiana?
Sure. So, I mean, one of the nice things about Select is we have assets in 10 different states and are active in every major unconventional formation. Thinking about the Haynesville in particular, we're the largest disposal provider in the Haynesville. We're also the largest disposal provider in the Marcellus Utica. So as those areas pick up, we're very well suited to support that activity, and largely indifferent to kind of the interest in oil or in gas. In the Haynesville, we have a pipeline that runs from the heart of DeSoto Parish down to Sabine County, and we're able to gather produced water all along that pipeline and dispose of it in a system. It's not too dissimilar from what we are working to create in New Mexico, with the exception of the recycling component. The state of Louisiana makes it a little challenging. We're working with them to try to get that changed. But it's a very strategic asset, and one that we don't believe could be replicated again today. And it's really the genesis behind our market leading position in that base.
If I remember correctly, you've got some unused capacity in that system. Any incremental barrel of water that gets put into that system is essentially a really high margin barrel, since it's filling up unused capacity. Is that right?
That's exactly right, and that's true with many of our disposal wells. We do have excess capacity there, and given that they are a higher fixed cost structure, that marginal barrel is very accretive. So we are focused on increasing utilization, and obviously with the increase in natural gas price and the more interest in the Haynesville and the Marcellus, that gives us a better opportunity to do that.
I'd like to bring us to a close today. I mentioned at the outset that the infrastructure segment is Select's highest or fastest growing and highest margin segment. Michael, with everything you have going on in the Delaware Basin and the other basins that Select is involved in, and then if you layer on top of that for the longer term future, the Colorado joint venture, how do you think growth in the infrastructure business will affect Select's earnings and cash flow visibility in the coming years?
That's a good question. There's a lot of places to take that. I guess to step back, we started as a service company and very deliberately made the transition to an infrastructure company. And we're still in the middle of that transition, although I think we've made some really good progress. And when we emerge from the other side, we will be an infrastructure service company as opposed to a service company, with infrastructure leading the way. Most of our growth capital over the last couple of years has been directed at infrastructure, and that will continue to remain true. Near-term cash flow, I think we've been very successful at winning large acreage dedications, primarily in the Northern Delaware, but in other areas too. And we're really not done there. We're not chasing growth for growth's sake, but we have a secular tailwind around recycling, and it's a unique time in the market, and our value proposition rings true. So we have a little bit of bumps here in oil, and I'm not sure if what's going to happen politically that would drive that up or down. But what I do believe very firmly is that when the iron's hot, you need to strike, and that's what we're doing in terms of building out our position that's we think is very defensible. As you think about the other side of that cash flow, growing infrastructure, it's supported by long-term contracts, it's supported by production. So our earnings potential kind of through cycles will be better than it's ever been in the history of the company because of the infrastructure position we have. And then obviously when you layer on the municipal industrial water, that's going to be more stable than anything else out there, certainly that has anything tied to energy. So we're really looking to kind of bring a little more stability, a little more predictability with some high margin business.
Michael, I think we'll leave it there for today. I want to thank you for taking the time to join us for our symposium. Thank you so much.
Appreciate you having me. Thank you, guys.
That will wrap up our WTR Symposium Series, Catch the Wave, Investing in Water Treatment and Solutions. I'd like to thank the management from our participating companies, including ARC, California Water Services, National Energy Services Reunited, and Select Water Solutions. Also, thanks to my equity research colleagues, Jeff Robertson and Peter Gastreich, for co-hosting with me today. Been a great symposium. And finally, special thanks to the producer and editor of this symposium, my WTR colleague, Joe Brunetto. Thank you for listening. Don't forget to subscribe as well as visiting our website at www.watertowerresearch.com, where you can stay up to speed on companies' small cap written research reports, podcasts, fireside chats, and conference schedules. We look forward to seeing you in another WTR Symposium Series podcast. Thank you, everyone.